Before our conversation with Mr. Surana of HPCL, let's also go across to Ajay to find out some of the factors that are making a strong case for a re-rating of these OMC names. Ajay?
Well, Abha, in the last 1 month, if there's one section of the market which has really got re-rated and moved ahead, that is the oil marketing companies. PPCL, of course, was leading the pack because of divestment buzz, but IOC, HPCL, etc. were also in the focus. We're also getting data that a lot of domestic funds have been loading up on OMCs last couple of months. A variety of issues. The GRM, Asian GRM picture is improving. Indian oil marketing companies are actually undertaking a lot of upgradation of refineries and expansion, which will improve their GRMs, and are focusing a lot on improving the valuations of the companies, which have, these companies have traded historically right now lower than their 10-year historic average and lower than private sector refiners. But now the way the government is focusing on improving the valuations of PSUs and also open to part strategic stake sale in some of them. There is clearly, market is clearly loving this space of oil marketing companies. Plus these companies are also focusing on non-fuel related revenues like petrochemicals and chemical, and they have very wide distribution reach, which is a quasi-retail play. So all these factors put together, the market is looking at oil marketing stocks in a very new light right now, and that's why we thought of getting you a management from one of them. HPCL's Mr. Surana will be joining us on the show to talk about the reasons, fundamental changes which are happening in oil marketing companies, because of which the market has started to look at these companies in new light.
Let's take that point forward. Joining us right now, Mr. M.K. Surana, the CMD at HPCL, joining in on the show right now. Mr. Surana, morning. Like my colleague was just highlighting, OMC stocks clearly in the last 1 month have gained very smartly because the market seems to be realizing their true value, and a type of re-rating literally happened ahead of the BPCL divestment. Do you feel Indian OMC companies are undervalued, looking at the assets they own and the sheer scale of operations as well as distribution reach?
Yeah, good morning to you. I think I maintained for a long time that Indian OMC stocks are actually undervalued. The type of assets which they own, the type of business model which they have, the type of demand potential which the country has, and the type of the refining capacity and the expertise which the country has. I think in that, if we put together, the Indian OMC stocks are undervalued.
Okay. Also, Mr. Surana, Asian GRMs have rebounded and have surged to a 2-year high. Do you see HPCL also benefiting in the coming weeks because of GRMs of the sector? Because, you know, they've been subdued for a long time now, and that only could be an added plus point to OMCs, in particular to HPCL.
Actually, if you see for some time, the MS cracks had been very low and diesel cracks were better, but with the impending IMO, diesel cracks are looking even better. And MS cracks are also slightly improving now. So it is expected that the product cracks will be overall on an average basis will be better than what we had earlier. Indian refineries are predominantly diesel producing refineries, and any improvement in diesel cracks has got a magnified effect on the overall GRM of Indian refineries. Compared to that, if the crude prices are on lower side, which is appearing as of now, then the fuel and loss, which is the fuel which we want in the refinery to process the crude, the value of that is lower, and therefore it adds to the GRM further. So overall, the GRM scenario looks definitely better than what we had at least in the last quarter or so.
Okay, that sounds fairly encouraging. But apart from this, Mr. Surana, we also understand that OMCs are looking at upgrading refineries, and eventually the valuations of the company can look to improve. Can you share with us specifically which are the refinery assets that are being upgraded, and what is the capex that you've assigned for this?
So I can talk of HPCL side. Of course, the BS6 production capacities are being, upgradation is being carried out in all the refineries of India. But as far as HPCL is concerned, in addition to upgrading for BS6 transportation fuel capacities, we are also expanding our both the refineries. So Mumbai refinery we are expanding by around 2 million ton from 7.5 to 9.5 and Vizag from 8.3 to 15. And these two projects are in very advanced stage, and Vizag is also having a bottom upgradation project. So this will at one end expand our refinery capacity, at the same time it will also improve the GRMs, because the newer facilities will bring a lot more energy efficiency and the capacity expansion, and therefore it should add to the bottom line of the companies as these projects get commissioned. In addition to that, on the marketing side also a lot of infrastructural projects which we are doing, especially the pipeline projects, which adds to the logistic cost. It helps in reducing the logistic cost and brings more efficiency in our secondary distribution, primary distribution, and so it definitely helps in improving the operational efficiency of the company and so the profitability of the company.
Okay, fair enough. So, as you said, it's definitely going to improve. How should, in your view, OMCs, be looked at in terms of valuations in the price per book a right way, or price per earnings perhaps? Should one look at a sum of parts, and how much profit contributing, from each segment really sort of adds into that? The market, of course, is believing that Indian OMC companies are grossly undervalued at this point. So how do you feel perhaps one should give emphasis on the various segments, and B is the best way to look at how to value the companies?
No, it won't be correct on my part to comment on how the market will value the company, because we being on the part of the management, it will be slightly inappropriate. And second thing, because the second quarter is completed, so it will not be possible for me to comment on the specific numbers or the profitability indicators for the company, because after some time we'll be declaring the results. But suffice to say that the GRMs can be expected to be better in Q2 compared to Q1, and the upgradation of the refineries and expansion should help in the time to come. The improving cracks should also be beneficial. The market demand should pick up now, which was subdued because of the delayed and extended monsoon. With the festive season coming in, I think the transportation fuels demand should also pick up now.
Mr. Surana, we understand you're already in your silent period, but what we wanted to understand is what is the right way of really valuing an OMC? Is it the sum of parts the right way, or would you say it is, price to earnings, which would be a correct multiple?
No, OMC valuation is a bit complex phenomena in the sense that one thing is the future demand growth which is possible in the country, which nowhere else in the world is expected, because India is likely to be the contributing almost 1/4 of the total overall growth in the energy space in the world, and India is already the third largest consumer. So one thing is the demand potential which we have, that need to be factored in. Second thing is that the assets which the companies have in terms of technical and non-technical assets, because all the infrastructure, the terminals, depots, petrol pumps, in various across the country, the cross-country pipelines, those are one part of it. The third part of it is the intrinsic valuation of the companies itself in the terms of the profitability, in terms of the efficiencies which the countries have, in terms of the infrastructure which they have already created in earlier, which can give quite a competition to the newer entrants. So there is no one fixed formula to say that the price to earning multiple may be the right thing, or the asset valuation may be right thing. And what about if somebody talks about the replacement valuation, it may still be the huge one. So it has to be a combination of it, and all need to be factored in my opinion. Suffice to say that right now I think the full potential of the companies have not been seen in the market. One more factor which always weighs in the market is the pricing part of it. But all these companies have got, of course, MS and HSD business, but there are also other businesses like lubricants, the other products which are not controlled or which are not guided by the market sensitivity of the prices at all, and works purely on the commercial basis. But normally the petrol and diesel prices start overweighing on the valuation of the companies. So the market need to factor in all those factors.
Sure, it already is. Mr. Surana, please stay with us. We're going to take a very short commercial break, but we have a lot more questions for you, so we'll come right back. Back with First Trades right here on ET Now. Still in conversation with Mr. Surana from HPCL, and he just highlighted to us, not giving numbers because they're in silent period, but yes, completely agreeing with the re-rating that the market is giving to some of these OMCs. And he said that GRMs are expected to be better in this quarter as well. They expect market demand to pick up from now. Festive demand will lead to higher demand. And yes, OMC valuations is a process which is pretty complex. Demand potential is enormous for fuel, and he expects further re-rating in OMCs. But Mr. Surana, what I also wanted to understand is how is HPCL aiming at getting a higher proportion of chemicals like petchem, etc., in its revenue pie going forward in order to diversify away from just pure fuel retailing, making bulk of its revenues?
Yeah, HPCL is, if you may be knowing that the new Bardmer refinery which we are setting up, the 9 million metric ton refinery in Rajasthan, has got it is a refinery cum petrochemical complex, so it will have 2 million metric ton of petrochemical production. Our HMEL, which is a joint venture refinery in Bhatinda, already has got a petrochemical facilities, and it is further setting up an additional petrochemical facilities for 1.2 million ton or so. So after commissioning of these two facilities, we'll have substantial petrochem capacities. Already in Vizag refinery, we do manufacture propylene, which is used by some of our captive customers, and we will have the expansions of those propylene facilities as well. So petrochem business is right now a profitable business, and almost all the refineries in the coming future model will be integrated refineries with petrochemicals. HPCL is also exploring that space very consciously, and we'll have the petchem capacities as well as marketing of that.
Before we
in addition to that, natural gas is another area where we have started our business. Yeah, the natural gas is another area which is more than just the normal liquid fuel transportation. And we already have got some 20 geographical areas which has been awarded to us. We are also a part of some of the cross-country natural gas pipelines, and we are also setting up a gasification terminal in Chara. So these two are the new business lines which will get added to our traditional business lines of fuels and lubes. Lube, as you know, HPCL had been a market leader in lubricant business. We had the biggest lubricating base oil processing facilities in Mumbai, and the marketing also, we had been the number one marketeer in that. So in addition to the normal fuel business, the lubes, the specialty products, the chemicals, natural gas, these are the additional business lines which helps the business, and to some extent it also provide a good risk mitigation in case there is likely to be any technological disruption on the traditional fuel space.
Before we let you go, Mr. Surana, I just very quickly wanted your view on how you see oil prices headed, and this in light of that temporary aberration that we saw because of Saudi Aramco refinery being hit, and then now recovery thereof.
Yeah, I think the Saudi Aramco incident, I think more or less have now passed on. The crude prices already come to around $58 as of yesterday. So I think that impact has been absorbed by the market to some extent. Going forward, if we see on the demand side, the projection in the world economy of the oil demand is slightly sluggish. India may be slightly better because of the festive season coming in and delayed monsoons, so the delayed activities will pick up now. But overall, the oil demand in the world is slightly subdued, and the projections have been revised downwards. On the US-China trade talks, settlement does not seem to be very near as of today, unless there is something else happens. And on the supply side, the US production is sufficiently high. OPEC has got the extra capacity. Currently, OPEC has not indicated anything to go for further discussions on any additional curbs, etc. So I think that the crude prices should remain in the range of 58 to 62 or so in near future. And I don't see any triggers currently which can change that situation to take the oil prices substantially high. As far as the cracks are concerned, we expect diesel cracks to be improving in the range of $16 to $18 or even higher. MS cracks are in the range of $6 to $8 and may remain around that. Fuel oil crack may go down depending on how IMO fans out. So overall, lower crude oil price, better cracks is what the scenario projected.
So much for staying by and giving us a view as to how things are shaping up for the company, as well as the outlook on crude oil prices, your GRMs, as well as what the outlook is on expansion plans and demand.